Hello everyone! Today, let's talk about an important technical indicator in the stock market, the Bollinger Bands. Bollinger Bands are composed of three lines and are widely used to assess stock price volatility, identify overbought or oversold conditions, and signal price breakouts. So how do Bollinger Bands actually work? Let's explain using a practical example. What are Bollinger Bands? Bollinger Bands consist of three lines. Middle band, typically the 20-day simple moving average SMA of the stock price. It represents the average price level. Upper band, the middle band plus two standard deviations. Standard deviation reflects the price volatility. Lower band, the middle band minus two standard deviations. The width of the Bollinger Bands changes with market volatility. When volatility is high, the bands widen. When volatility is low, the bands contract. Stock price breakout signals. When the stock price breaks through the Bollinger Bands, breakout above the upper band could indicate the market is in an overbought condition, and a pullback may be imminent. Breakdown below the lower band could signal the market is oversold, and a potential rebound might occur. Narrowing bands. When the bands narrow, it usually means that market volatility is decreasing, and a large price move may be imminent. At this point, you should pay attention to the direction of the breakout. If the stock price touches the lower band and then rebounds to the middle band, it suggests that the market may be returning to normal volatility levels. Conversely, if the price breaks through the upper band and then pulls back to the middle band, it could be an adjustment after an overheated market. Example. Let's say a stock has been fluctuating upwards for a period of time, and the width of the Bollinger Bands gradually narrows. The price movement becomes smaller and smaller. This often signals that a larger price move is coming. Sure enough, the stock breaks above the upper band, and the volume increases. This indicates the stock might be entering an overbought zone, with a risk of a short-term pullback. The stock then starts to pull back and quickly drops toward the middle band. During this process, the lower band acts as support, and the stock doesn't fall further, showing signs of a potential rebound. If the stock breaks above the upper band again, it means the upward momentum is still strong, and the probability of further price increases rises. How to use Bollinger Bands effectively? Breakout signals. When the stock price breaks above the upper band, consider selling some positions to avoid risks associated with excessive price increases. When the stock price breaks below the lower band, consider buying to capitalize on a potential market rebound. Waiting for narrow bands. When the bands contract, market volatility decreases. You should wait for a breakout above or below the bands to make a decision. This is often followed by larger price movements. Middle band as support resistance. The middle band often acts as a support or resistance level. If the stock price crosses above or below the middle band, it could be a signal of a trend reversal. Conclusion. Bollinger Bands are a very useful technical tool that can help us gauge market volatility, identify overbought and oversold conditions, and recognize breakout signals. When the bands narrow, it suggests the market is preparing for a period of higher volatility. When the price breaks through the upper or lower bands, it could indicate a potential trend reversal. Using Bollinger Bands in conjunction with other indicators can help you make more informed decisions and better navigate market movements.